Hello everybody. This is lesson 10 of the lecture International Financial Markets. I will discuss slides 109 to 121 of chapter 2, Major Market Segments and their Assets. In this lesson I will talk about the foreign exchange forward market. As a starter, let's repeat again the difference between spot and forward market. As already discussed in lecture 9, on the spot market, euro today is traded against dollar today. So purchase agreement between buyer and seller and the exchange of currencies delivered by the seller to the buyer takes place today on the spot. That's why we call this market spot market. On the forward exchange market, however, a euro is, for example, traded against the dollar at some future point in time, let's say 3 months ahead, at an exchange rate fixed today. So the agreement between buyer and seller about the exchange rate takes place today in the present, while the exchange of dollar against euro takes place in the future at t equal to 3. Standard forward exchange rates are written for 1 month, 3 month or 1 year. Now we have already seen in lecture 9 why people engaged in international financial investments use forward markets. Now I would like to show that also people engaged in international trade with goods and services have a strong motive to use forward exchange markets. Let's, for example, consider how the following companies could reduce their sales risk caused by fluctuations of the exchange rate. On one hand, we have a European car manufacturer who sells one car to an American dealer, let's say 1 month forward at a price of $20,000 payable at the date of delivery. The production costs for this car are 8,000 euro. At the current spot exchange rate of, let's say, $2 per euro, the company could cover its costs and make a profit of 2,000 euro. If the euro would, however, appreciate, let's say to an exchange rate of $4 per euro, the company would make a loss. The dollar sales revenues of $20,000 would then have a euro value of only 5,000 euro, such that the incoming revenues would not cover the costs and a loss of 3,000 euro would result. So this is the exchange rate risk of the European car manufacturer. Let's assume that on the other hand we have an American manufacturer of, for example, refrigerators who sells 100 refrigerators to a European dealer 1 month forward at a price of 10,000 euro payable at the date of delivery. The production costs for 100 refrigerators are $18,000. At the current spot market exchange rate of $2 per euro, the company could cover its costs and make a profit. In this case, 10,000 euro, would have a market value in dollar of 20,000, which is sufficient to cover the costs and still have a profit of $2,000. If, however, the euro would depreciate against the dollar, let's say to an exchange rate of $1 per euro, the company would make a loss. Because in this case, 10,000 euro would have a dollar value of $10,000, and that is clearly not sufficient to cover the costs, such that the company would end up with a loss of $8,000. What kind of deal would reduce the sales risk of both manufacturers? The manufacturers could sign the following forward contract. The European manufacturer sells the American manufacturer his $20,000 income in exchange for the 10,000 euro income of the American manufacturer. And the exchange takes place in 1 month. So 1 month ahead in the future. This implies an implicit forward exchange rate of $2 per euro, since we give away $20,000 and receive 10,000 euro. This forward contract would completely eliminate the exchange rate risk of both manufacturers. This risk would be zero. This is possible because the exchange rate risk of both manufacturers are perfectly negatively correlated. We have already seen that under such a condition, if there is perfectly negative correlation of returns, a perfect hedge is possible when we discussed the hedging effect at the beginning of this chapter. So here we have in fact such a situation, and the forward contract can be interpreted as a portfolio that is formed by both manufacturers. Consequently, given a forward market that allows such kind of deals, manufacturers can sell their products to different currency areas without any exchange rate risk. So in this sense, forward markets can help to make the world a little bit safer, or at least less risky. Now let's consider the slope and the position of supply and demand curves on the forward market for foreign exchange. Let's first consider the slope of the forward supply curve. It is a positive slope, which implies that the more forward dollar are paid for 1 euro, the more sales to European goods markets are profitable for American producers. Consequently, the more euro is supplied to the forward market. So an appreciation of the euro in the forward market causes an increase of supply of euro on the forward market. Now let's turn to the slope of the forward euro demand. The less forward dollar have to be paid for 1 euro, the more sales to American goods markets are profitable for European producers. Hence, the more euro is demanded on the forward market. So if the euro depreciates on the forward market against the dollar, more selling of European goods to the American market becomes profitable, and hence more forward euro is demanded by European producers in order to repatriate their dollar revenues into euro. So far, we have motivated transactions on the forward exchange market by trade with goods. However, another important motivation for transactions on the forward exchange market comes from capital markets. As we've already seen, the forward exchange rate appears in the interest parity equation. Hence, all changes that affect the other variables in this equation may also affect the forward exchange rate. This is shown by the following considerations. Let's consider a situation in the beginning where the interest parity relationship holds. So a return on a euro bond is equal to the euro value of the return on a dollar bond. Now let's assume that, for example, the dollar interest rate increases. What consequences will this have for the forward exchange rate? Well, in this situation, for a short moment in time, the return on the dollar bond would be larger than the return on the euro bond. So, for example, Europeans would have a strong incentive to invest now more money in dollar bonds. If they do so, they will have a dollar revenue in the future which they have to exchange into euro in some future point in time when the maturity of these dollar bonds is given. This means they would supply forward dollars from their dollar revenues on the forward market in exchange for forward euros. So supply of forward dollar grows, demand for forward euro grows, which means that the euro appreciates on the forward market against the dollar when the dollar interest rate increases. This is the opposite reaction as we can observe for the spot rate. We have already discussed this. Now, let's consider the opposite. Let's assume that the euro interest rate goes up now and the dollar interest rate and all other variables stay unchanged. So this implies that for a short moment in time, the return on a euro bond is now larger than the return on a dollar bond. So now Americans would have an incentive to invest more dollars into euro bonds, and by the end of this investment they will have euro returns which they have to repatriate, bring home in exchange for dollar. So they would on the forward market demand forward dollar and supply forward euros from their bond returns. As a result, now the euro would depreciate on the forward market. If the euro interest rate goes up, in other words, the euro depreciates on the forward market. Again, as we've already seen, the spot exchange rate would appreciate in such a situation. So, as this example shows, the forward market is hit by exchange rate changes in exactly the opposite way as the spot exchange market. I think this is a remarkable feature of the forward exchange rate. So much for this lecture. In the next lecture, I will talk about markets for forwards and futures of all other assets.